Hello, everyone. My name is Laurent. I'm the managing partner of RVC, Ilavska Vuillermoz Capital. We're one of the earlier investors in Teylor.
You made a good bet.
And so maybe Patrick, maybe you can tell us, what does Teylor do? Maybe in a few sentences to the people know what it's about.
Yep. So basically, what Teylor has built in a nutshell is that we built a platform that tries to automate the entire process of giving small business loans, and we use this technology in different ways. On the one hand, we're now in the meantime the largest alternative SME lender on the German market. Outside of the German market and in some areas of the German market that we're not active in, what we do is we license our technology to other players who are in the same space. So that means if there's areas of the market that we, for whatever reason, can't get into, we find local players and give them the technology.
Okay, so for the people that don't know Teylor, you acquired your largest competitor recently called Credit Shelf, and maybe you can dive a bit into how this happened and what are the benefits of such a merge or such a company also going forward now.
Absolutely. So I mean, for us, where we stand today, we're funding we'll do this year about $500 million in small business lending through our platform in the German market. So obviously for us, the question is always how do we grow? How do we grow faster? How do we grow more aggressively than we're currently growing? And there's multiple ways that we can do that. Obviously, number one is organic. We're constantly developing new products, hiring more staff, growing the company on our own. But of course, there is always the other option, which is where you do a kind of market consolidation play and try and acquire competitors who maybe have great teams or great products or great sales channels or whatever it might be. And that's where the Credit Shelf kind of transaction falls into place. So for us, it was a natural fit because our primary focus is kind of small business lending in the 100,000 euros up to maybe at most 1.5 million euro range. But Credit Shelf, which was, as you said, our largest competitor, they were focused on kind of 1 million to maybe 3, 4, 5, 6 million. So exactly one customer segment above us. So it was very natural for us to kind of have the discussion and think, okay, do we want to launch our own product in that space? Or do we work together with someone that has a track record there, that has funds and origination channels and so on already there? So we started the discussion some time ago already, and then unfortunately they were
listed as well, no?
Yeah, so they were a publicly traded company in Germany, listed on the Frankfurt Stock Exchange, I believe it was, founded in 2014 or 15, so also quite a bit older than we were, and so them being listed was a bit of a pain, just simply because we tried to do M&A transactions before, but it's significantly easier to do an M&A transaction if you're trying to purchase a company that's privately held and you go to the founders or the investors and you have a discussion, versus when you have the regulators, a million lawyers.
And also secrecy. I mean,
absolutely.
I remember you told me about the plans to buy a listed company, and the first thing you told me is, Laurent, if I give you this information now, then I have to report to BaFin that we are talking, that I know because of insider trading. So obviously that is a bit of a challenge.
Exactly.
But the story is always nice if you have you delist a company and then list it again. Those are amazing businesses.
Absolutely.
Yeah. So you give out your own money as well. I mean, you have your platform, you have your software, and you recently set up a 275 million private debt fund in Luxembourg, based in Luxembourg, and also deployed from here. So tell us a bit, who are the investors there as well, and why did you choose Luxembourg? We're not here to promote Luxembourg, but there's a reason why you're here, and maybe you can tell us a bit the reasoning about the reasoning why you're in Luxembourg with your rather big fund for somebody who did it for the first time.
Absolutely.
Basically.
I mean, in the meantime, we actually have 4 different vehicles that are primarily situated in Luxembourg. The biggest one is this most recent one that we've set up, which is an ABS vehicle where we have Barclays and M&G as the primary senior and mezz lenders, plus a collection of smaller kind of asset managers and private debt funds who are also invested into various tranches of this fund. The historical reason why we started setting up these vehicles was because when we started the company in 2019, we were mainly doing kind of forward flow lending, where we would do the origination and the underwriting, but the loans would live on the balance sheets of various partner banks that we were working with. Over time, anyone who's in the private debt kind of sphere will know that there's been quite a boom in the kind of private credit, private debt area over the last couple of years. So we had huge demand from everyone from asset managers, other funds interested in kind of investing into this asset class of SME loans that we were generating. So I think we set up our first fund in 2020, I think it was 2021. And honestly, it was a bit of a no-brainer for us to come to Luxembourg, because it was kind of, you have all of the infrastructure, you have all of the people. We had a great luck of having great support from a lot of good people here. So obviously, I think the Alan Novery team is here somewhere. So big shout out to them. And if I give them a shout out on stage, they have to give me a discount at the next vehicle we set up with them. So yeah, I mean, the reason why we chose Luxembourg is because you can literally go to any investor and say, yeah, it's a Lux Ray for whatever it is, and they'll instantly understand it. And believe me, we have enough kind of trouble with everything else that we're doing as a startup to scale up, that you don't also want to add complexity to kind of the refinancing structure. And that was for us a big motivation. Yeah.
So, and your market is consolidating currently, and you're the strongest player currently in Europe, at least.
Yeah.
So you need more money.
Yes.
And your VC case, I mean, we invested several times ourselves, but after a while you want to have also other investors participating. Maybe you can walk us a bit through the process, how you see in your VC case now, how is the fundraising going in general, or how do you see the markets, and what the plan is with the money that you're going to raise?
Yeah. So the way that I see it right now is kind of compared to maybe 2019, 2020, where there was a lot of money flowing into VC and a lot of deals being done. I think the market, obviously, especially in the fintech space, tightened quite significantly over the last couple of years. What helped us a lot, and the reason why we were never really affected by this, was the fact that we were from day one always kind of focused on high growth, but also kind of always getting to a place where we were either break even or profitable. I remember when we first spoke, that was one of the things that you liked a lot about us, that we were at the time already breaking even though we were growing 200% per year.
And back then that was not so important, you know.
Absolutely.
When we started investing, I don't know, it was 2019 or
I think it was 2020.
It was still market where it was growth at any cost, and we wanted to just see a lot of growth, put money there. There was cheap money everywhere.
Yeah, absolutely.
But then markets crashed, and then we decided, okay, we will focus and we will support the companies that are close to profitability or profitable. And Teylor was one of the cases that already then worked profitable, and that basically is also part of your success for now.
Absolutely.
That you're still there, and all the others, like Credit Shelf, is not there, but it's now with you.
Yeah, I think this was for us kind of a game changer also, in terms of being able today, or being able through the lifetime, always to raise a lot of, raise money relatively. It's never easy, but compared to some of our colleagues who are maybe in the market and focused just on spending money more than making money, it put us in a better position. When I look at the market today, that you see very clearly kind of that split between the companies that maybe have good fundamental unit economics versus those that didn't. And I think those that don't have such a problem fundraising, and there's certainly more focus and appreciation from the VCs, obviously, for that, and that helps us a lot. Kind of looking at the market more generally, independent of now our case, what I see is that funding is coming back slowly. I think there's a bit more activity happening in the kind of larger ticket spaces, because a lot of these bigger funds do have capital to deploy. I think there's not so much activity yet in the kind of more early stage fintech stuff, just because I think many people burnt their fingers over the last couple of years. So maybe that capital is a little bit more skittish. But yeah, for us, we're raising at the moment a 25 million euro round with the option to top up by another 50 to 75 million. Focus of that will be primarily organic growth and M&A acquisitions.
Okay. There will be more opportunities in your space to see, like in 1-2 years, to acquire some more companies.
I think not just in 1-2 years. I mean, we want to do ideally another 2 to 3 transactions this year. So for us, the way that I see the market is that you've got a lot of great fintechs with great products who just didn't reach the scale necessary to survive without a lot of VC capital. But you also have kind of more traditional financial services players where the regulatory burden is always increasing, the cost of capital is always higher, and if you don't have a good kind of technology platform or origination structure, it makes more sense to be part of a bigger platform.
So going back on away from the fundraising into more the market in general and where you generate your revenues.
Yeah.
We have some very volatile interest rates, or we have higher interest rates now than when we started, or when you started the companies. Can you explain us a bit how the interest rates now change your business and your revenues?
Yeah. The good thing is, I think that for us is that we set up our fee structure so that we get fees at origination of a loan and we get a fee for servicing the loan, independent of what that interest rate is. So we don't get any interest earnings, which in retrospect really helped us quite a bit because we're just kind of steady, and you can see as long as the portfolio and we're originating more, we have relatively steady revenues. Where we feel the difference is that I think borrowers over the last couple of years have become obviously much more hesitant to take on credit compared to a zero interest rate environment where it obviously makes a lot of sense. But that's changing as well now, because I think that so we had the interesting case speaking to our customers maybe in the first year after the change of the rate environment, where a lot of people were telling us, why should I pay, 8% for my business loan when I'm paying 2% for my mortgage? And fair enough. It's a understandable position. Obviously, our answer is, okay, you can pay 8% now, or you can pay 12% in a year when the rates keep rising. So it didn't really affect us that much. What we did notice, of course, is that there are certain industries that we used to lend into more aggressively that have been more hit kind of due to second order effects. So we used to do a lot of lending not in the construction industry specifically, but kind of in the supporting industries. So, building scaffolding for construction sites, building machines for construction sites, those have taken significant hits. So even if they might be willing to pay the higher interest rates, their economics are so bad that you wouldn't want to lend to them. Yeah.
So, and in order to keep your default rate low, I'm sure you implement a few technologies, and it wouldn't be a good panel if we wouldn't talk about AI, obviously.
Absolutely.
Because otherwise, I think we're getting kicked out. I think we need AI for the climate control here, in my opinion. But okay, that's for the next. We have 2 more minutes, so maybe you can tell us a bit more about how you implement AI into your lending technology.
Yeah, absolutely. Kind of fundamentally, when we hire credit analysts to work with us or to do our underwriting, we always tell them kind of on day one, our goal by hiring you here and what we're doing is to make you unemployed and to make you be able to kind of sit around all day long, because we want to be able to have the system do all of the work that you would otherwise do. So what we're basically trying to do is we gather all of these data points of all these companies that we've underwritten, which is thousands and thousands in the meantime, plus their performance after we pay out a loan, and basically try to kind of this whole credit analytics process to completely automate it away, everything from flagging of potential frauds and things like that. We're making very good progress in a lot of these areas. So, for example, for many regulatory reasons, we often, for example, have to write a detailed analyst report. That's almost completely going to be automated away by the end of this year. We have a North Star KPI which measures how many human hours is involved per loan, and our goal is to get that down to 0, basically. And that's all with AI, because every small business is different. It's much more heterogeneous customer base than in retail credit, and that's why we need to have a lot of data, a lot of tech to be able to kind of standardize how we treat these customers.
Okay, well, so last question, bit more personal question.
Yeah.
So what I know is that you were a soldier yourself. You were a soldier in Kosovo.
Yeah.
You were even teaching. I don't know what you call it.
As an instructor.
You were an instructor, yeah. Exactly. So how do you implement the learnings from your time in the military into the company that you're building up? You have 1:45, and you're a soldier. You have 42 more seconds to answer that question.
So after I did my military service in Switzerland, I stayed on. I worked as an instructor in the infantry boot camp, and then I went to Kosovo to do some peacekeeping missions. I think the good thing is, obviously, every time I'm having kind of really a tough moment at work, I kind of look back and say, okay, I've been in much more stressful, dangerous, sleepless situations than I'm in right now. And relative to back then, when I was really in maybe some pretty crappy situations, having to deal with whatever, some fundraising or something, it's not that big of a deal. So I think it helps me keep my cool, I would say.
And maybe in the future, your knowledge is important now due to the new geopolitical
Absolutely.
situation. So we are on time, and thank you very much, everyone, for listening.
Thank you,
See
everyone.
around.
Thank you, Laurent.